Mastering Emotional Control in Trading, the Ultimate Psychological Guide for Consistent Profits by BookSmartClub. Introduction. The financial markets represent one of the most challenging psychological battlegrounds where fortunes are made and lost, not just through analysis and strategy, but through emotional mastery. While most trading education focuses heavily on technical indicators, chart patterns, and fundamental analysis, the critical component of emotional control often gets overlooked. This book aims to correct that imbalance by providing you with an in-depth examination of trading psychology and practical techniques to develop the mental discipline required for long-term success. Trading is unique in that it constantly tests our psychological limits. Unlike most professions where effort correlates directly with results, trading presents situations where perfect analysis can lead to losses and impulsive decisions can sometimes yield profits, until they don't. This unpredictability creates a perfect storm for emotional decision-making that can devastate trading accounts. The journey to becoming a consistently profitable trader is as much about understanding yourself as it is about understanding the markets. This book will guide you through the complex landscape of trading psychology, helping you identify emotional traps, develop mental resilience, and implement practical strategies to maintain discipline, even during the most volatile market conditions. The psychology of trading. Why emotions matter. To understand why emotional control is so crucial in trading, we must first examine how human psychology interacts with market dynamics. The financial markets are essentially a reflection of collective human behavior. Fear, greed, hope, and regret all play out in price movements. As traders, we're not just analyzing charts. We're interpreting mass psychology in real time. Our brains are wired with certain evolutionary biases that served us well in primitive environments but work against us in trading. The pain of loss feels about twice as intense as the pleasure of gain, a phenomenon known as loss aversion. This explains why many traders hold losing positions too long, hoping they'll turn around, while cutting winners short to lock in gains. Another critical psychological factor is the illusion of control. Humans have a deep-seated need to find patterns and explanations, even in random data. This leads traders to see patterns where none exist, or to believe they have more control over outcomes than they actually do. The reality is that even with perfect analysis, any single trade has a degree of randomness. The confirmation bias is particularly dangerous in trading. Once we've taken a position, we tend to seek out information that supports our view while ignoring contradictory evidence. This mental trap can turn small losses into catastrophic ones as traders stubbornly hold on to losing positions. Understanding these psychological tendencies is the first step toward overcoming them. The most successful traders aren't those who eliminate emotions entirely. That's impossible. But those who recognize their emotional responses and have systems in place to prevent those emotions from dictating their trading decisions. The most dangerous emotions in trading. Fear, the profit killer. Fear manifests in trading in several destructive ways. There's the fear of missing out, FOMO, that causes traders to enter positions too late, after much of the move has already happened. There's the fear of losing that leads traders to exit positions prematurely, often right before the trade would have turned profitable. Then there's the fear of being wrong that prevents traders from taking valid setups in the first place. The physiological response to fear is identical whether facing a physical threat or a losing trade. Increased heart rate, sweating, tunnel vision. In trading, this response impairs our ability to think rationally just when we need clarity most. Many traders describe freezing during crucial moments, unable to execute their planned strategy. Greed, the illusion of easy money. Greed distorts our perception of risk and reward. It's what causes traders to abandon their risk management rules when they see an opportunity for big profits. Greed makes us hold winning positions too long, turning potential gains into losses as the market reverses. It's also what drives overtrading, the compulsive need to be in the market even when no good setups exist. The dangerous thing about greed is that it's often reinforced by early success. A beginner might have a few lucky trades where breaking the rules leads to profits, creating a false association between reckless behavior and success. This sets up a pattern that inevitably leads to significant losses. Revenge trading, the downward spiral. Revenge trading occurs after a loss, when traders try to immediately get their money back by taking larger, riskier positions. This emotional response ignores proper analysis and risk parameters. The revenge trader often compounds losses by doubling down on bad positions or jumping into new trades without proper setup. This behavior stems from our innate desire to resolve cognitive dissonance. After a loss, there's a psychological need to prove that we were right, that the market was wrong. This leads to increasingly irrational decisions as the trader tries to validate their original thesis rather than objectively assessing the current market conditions. Overconfidence, the success trap. After a string of winning trades, many traders fall into the overconfidence trap. They begin to believe they've figured out the market, that their skills are infallible. This leads to taking larger positions, deviating from proven strategies, and ignoring risk management principles. Overconfidence is particularly dangerous because it often follows genuine success. The trader may indeed have improved their skills, but markets constantly evolve. What worked yesterday may not work tomorrow. The overconfident trader stops being cautious, stops learning, and inevitably meets with losses that erase previous gains. Building a disciplined trading mindset. The trading plan, your psychological anchor. A comprehensive trading plan serves as an emotional anchor during turbulent market conditions. It should clearly define 1. Market conditions you'll trade, trending, ranging, high volatility, etc. Second, specific setups you'll look for with clear entry criteria. Third, position sizing rules, percentage of capital per trade. Fourth, stop loss, placement methodology. 5. Profit-taking strategy, fixed targets, trailing stops, etc. 6. Daily, weekly loss limits. 7. Time frames you'll trade. 8. Instruments you'll trade. The more specific your plan, the less room there is for emotional interpretation. When uncertainty strikes, you can fall back on your predefined rules rather than making impulsive decisions. Risk management. The foundation of emotional stability. Proper risk management does more than protect your capital. It protects your psyche. Knowing that no single trade can significantly hurt your account provides tremendous psychological relief. Key principles include Never risk more than 1 to 2% of your capital on any single trade. Set stop losses immediately upon entering a position. Adjust position size based on the distance to your stop loss. Have a daily loss limit after which you stop trading. Diversify across uncorrelated assets. When you know exactly how much you can lose before entering a trade, fear and greed have less power over your decisions. The Trading Journal, your path to self-awareness. A detailed trading journal is perhaps the most powerful tool for improving emotional control. Beyond just recording trades, it should document 1. The market conditions at time of entry. 2. Your emotional state before, during, and after the trade. 3. Any deviations from your trading plan. 4. The thought process behind each decision. 5. Lessons learned. Over time, patterns emerge. You might notice you tend to overtrade on Fridays, or that anxiety causes you to exit positions too early. This self-awareness allows you to develop specific strategies to counteract your personal psychological tendencies. Practical techniques for emotional control. Breathing and meditation for traders. Controlled breathing techniques can short-circuit the body's stress response during intense trading moments. The 4-7-8 technique is particularly effective. 1. Inhale quietly through your nose for 4 seconds. 2nd, hold the breath for 7 seconds. 3. Exhale completely through your mouth for 8 seconds. Daily meditation practice strengthens your ability to observe thoughts and emotions without reacting to them. Even 10 to 20 minutes per day can significantly improve emotional regulation. Developing patience, the trader's virtue. Patience manifests in several critical ways, waiting for high-probability setups rather than forcing trades. Allowing trades time to develop without premature exits. Staying out of markets when conditions aren't favorable. Avoiding the need to be constantly active. One effective technique is to maintain a watch list of potential setups, but only act when all criteria are met. This creates psychological distance between observation and action. Handling losing streaks. Every trader experiences drawdowns. How you handle them determines long-term success. 1. Accept that losses are inevitable and don't reflect on your worth. 2. Reduce position sizes during drawdowns to minimize stress. 3. Take a short break after consecutive losses to reset mentally. 4th, review trades objectively. Was it bad luck or a flaw in strategy? 5. Remember that even the best systems have losing periods. Mindset shifts for long-term success. The paradox of acceptance. Ironically, the more you accept that losses are part of trading, the better your results become. This acceptance allows you to take stops without hesitation, avoid revenge trading, maintain emotional equilibrium, stick to your system through inevitable drawdowns, process over outcome. Focus on executing your trading plan perfectly rather than obsessing over profits and losses. Good decisions sometimes lose money, and bad decisions sometimes win. Over time, the law of averages ensures that proper process leads to positive results. Detachment from money. View your trading capital as chips in a game rather than personal wealth. This mental shift helps remove emotional attachment to individual trades. Some traders find it helpful to think in terms of percentages and risk units rather than dollar amounts. Continuous learning and adaptation. Markets evolve, and so must traders. Maintain a student mentality regardless of experience level. The moment you think you know everything is the moment you become vulnerable to major losses. Conclusion: the path to mastery. Mastering emotional control in trading is a lifelong journey with no final destination. Even the most experienced traders continually work on their psychological discipline. What separates consistently profitable traders isn't some secret indicator or system. It's their ability to manage emotions and stick to their process through all market conditions. The techniques outlined in this book provide a comprehensive framework for developing this crucial skill set. However, knowledge alone isn't enough. Lasting change requires consistent practice and honest self-reflection. Start small, be patient with yourself, and remember that every master trader was once a beginner, struggling with the same psychological challenges you face today. True trading success comes not from conquering the markets, but from conquering yourself. By committing to the principles of emotional discipline outlined here, you're not just becoming a better trader, you're developing mental resilience that will serve you in all areas of life. The markets will always present opportunities. Your job is to ensure you're psychologically prepared to take them.